Yes, good afternoon, everybody. I hope you can hear my voice. Also, see my screen clearly. Today is 19th. This is 10th of May. So today's webinar is going to be one very interesting one. This is something which I'm not saying I advocate for 15 minutes, but it's always good to confirm with whoever is advising you how you can trade on 15 minutes correctly. Because personally, I do not recommend 15 minutes as a time frame for trading, but I recommend from 1 hour. That it's really good. It works really good on the 15 minutes time frame. It's just a combination of some few indicators. You can use some moving averages. You can use some oscillators. You can also use some other set of maybe trend indicators. So the ones which I use here is a combination of two indicators. It's a combination of just two main indicators. I use two moving averages to be specific. I do use the 200 period moving average, and then I use also the 20 period moving average. So the idea is to buy across a slow moving average. If the 200 period moving average goes below the 30 period moving average, then we pick a long position. And if the price goes, if the slow moving average goes above the fast moving average, then we pick a sell position. So that is technically what happens. Another thing which we have to take into account is what is currently happening. Is the price overbought or is the price oversold? If you find a cross where the price is oversold or overbought, then that gives us some ideal situation for us to consider a position. So we'll look at this chart. I will add the moving averages. We start off with the 200 period moving average. This is 200. You cannot see it because it's when I'm adding it. We have the 200. This is the 200 period moving average. And then the next one is 30 period moving average. And this one, we give it appearance of blue. So this is upwards. Look at this. Look at what happened when the cross happened at this point. We had a buy position here. And then if the opposite cross happened, we had a sell position. So our main objective here is to sell, and then you fix your stop loss above the previous low or below, below the previous low or above the previous day's high. So that's one thing. And then you pick your profits as fast as you're in money. So if the next 5 minutes after entry, the price goes your way, you get out from that one. Like we will come here, and then the next after the entry, that is if there's a cross like the one we're seeing here, then in the next 15 minutes, the price goes our way, we just step out. So anytime the price goes our way for 15 minutes, we step out. Anytime the price goes our way for 15 minutes, we step out. And we'll buy it here, we'll wait and sell it somewhere here. That means we'll wait and sell it somewhere here. And then we'll wait and buy it somewhere here. Wait and buy somewhere there. And then we'll wait and buy it also somewhere there. And then we'll wait and sell it somewhere there. Then we'll wait and buy it somewhere here. So what we want to happen is we want price to give us a good place to be looking for a sell from. Anytime the black line slides above the blue line, then that's a sell position. Anytime the blue line goes above the black line, that becomes a buy position. And as I've said, your stop loss should be below the previous day's lowest low or the current day's lowest low. So if you find a case where the current day's lowest low is lower than the previous day's lowest low, then that becomes the place where you have your stop loss. And if you find a case where the previous day's candle is actually lower than the current day's lowest low, then below the previous day's low, that's where we have our stop loss. Our take profit, as I've said, is just the next candle. So we are taking profit based on candles. If the price goes our way, maybe for like 5 minutes, we step out. If the price goes against that, then we have our stop losses fixed below the low or the high of the previous day. Does that make sense? So you also want to avoid a case where you're having several trades running at the same time. If a cross happens today, you enter sell position, the stop loss is not hit, the take profit has not been hit already. The best you can do is to wait for price until it hit any of those levels before you trigger any trade. That's that day. So we will not pick a trade within the same day until the next day comes in. Like on this day, on 6th of May here, we took a sell position. The entire day we can see that there's no cross at all. We wait for the next day. Sorry, I got interrupted while I was talking. So as I was saying, anytime the cross happens, anytime you find a cross like this, don't just find yourself entering the trade without first confirming what's happening on the other indicators. So the idea is to avoid cases where you're trading just one thing, that's the moving averages, or you're trading the stochastic, or you're trading just the RSI. Look for cases where everything is supporting your position. So if it's a buy, let that buy be evident everywhere. So if you have a buy on one symbol, maybe you have a buy on the RSI showing us a buy, ensure that the stochastic is showing us almost a similar thing, and also the moving averages are also showing us the same thing. Then, so as I was saying, you better learn how to correlate symbols. Better learn how to correlate symbols. Correlation simply means a variety of doing exactly the same thing at the same time. So if you have the entire market and then some symbols suddenly begin to do the same thing, that is, they begin to show you the same signal, all of a sudden they're doing the same thing, then that means they're positively correlated. So as I was saying, we look for the same symbol. Like if you want to trade successfully, don't just focus your analysis on one symbol, because there's another. So if you have instantly, then that's when the act of correction becomes active. So that's usually the correct time to start thinking of a trade. It's the correct time to trade when everything is showing you the same thing. So consider that the market should move in an holistic manner. That is, in a way that if we're a buy, everything should be showing us a buy, and all the other opportunities. That is always the correct time to consider looking for a trade, when majority are showing you the same thing while the others are showing you something opposite. We clear? So this is the strategy. A cross between two moving averages, and then you attach the ADX indicator. The ADX is basically the average directional movement index indicator. It's just a trend indicator. And what it means is there is the green line, and then there's the red line, then there is this thin line. The red line being above, the green line being above the red one means that we are in an uptrend. And the red line being above the green one means we're in a downtrend. And if this line, the other thin line, is above the 25, level 25, then that means that trend, whether it's upwards or downwards, it's active. It's active. That is, it's very useful. It's working out properly. So thank you very much. That should be the end of today's session. We'll meet again next week at the same. So thank you. See you.